Welcome to the Dividend Talk podcast, episode 82 Value Investing with Cameron Stewart. Hey guys, welcome back to another episode of Dividend Talk. In this episode, we're going to talk about Philips's 15% drop, some growth stocks that have also declined. Cameron Stewart's going to give us a masterclass in value investing, and we're going to answer questions from the community. All that and more. See you on the inside. Hey, European DJ, how are you this Friday evening?
I'm feeling really, really great because we have a great guest on the show. And other than that, a bit tired from work, but trying to escape the grind one day, right? But tell me, how are you feeling today?
Well, I hope I'm as happy as you look because you just look so excited there. So, look, I'm going to give you the honors. Just go ahead and introduce our guest. Get him onto the show.
Yeah, so, to all the listeners, we've got Cameron Stewart here as a guest today. Cameron Stewart is, I mean, if you don't know him, I don't know, but he's for me the value investor on YouTube. I learned a lot from him as well, watching all his videos about how to do, how do you call it again, rational investing and cash flow investing, and cash flow is king. So I'm so happy that you joined us today, Cameron, and welcome to Dividend Talk, and you know to a European audience, let's say.
I'm happy to be here. Thank you so much for having me. I really appreciate it. I'm excited to kind of hear your perspective and chat a little bit.
Cool. Just before we start, you just want to give our audience maybe a brief introduction of who you are, what you do. Don't have to be too long. Just something brief.
Sure, I'm a professional CFO. I've been investing for probably 30 years. Started as a boy, and during the pandemic, I started a vlog on YouTube just as my journey evolved, and I've been blown away by the response. And I continue to lean into it, and it's focused simply around what is the true cash flow of a business and how much should you pay for it.
Cool. And you mentioned CFO. Is it possible to put an F still in front of it, or?
Yeah, free cash flow. I love free cash flow, and I've kind of carved a niche out for myself professionally as a career, turning around struggling companies. I'm now in my third round with this private equity group, and I take what I've learned at the board meetings and M&A acquisitions at the corporate level, and just lay it out as simply as I can to educate the people who are interested in learning. It's not rocket science. It just takes a little bit of practice.
Nice. So we will get into that. We'll get into more about your story, and we have tons and tons of questions for you. So we'll get into that shortly. But what we usually do at this point is we'll just talk a little bit about the news of the week. This might be a little bit more European focused, but just feel free to throw in your 2 cents worth.
I'll try. I'm not sure I know that much of the European news, but I'll try.
Okay. European DJ, I'm sure this obviously interested you. I know you had a video on them, which is Philips. They had a bit of a shocking week in the stock market.
Yeah, so what they did is they gave an earnings update this week, and they have to again, I say to reserve some cash, like 225 million, for the recall, the respiratory devices. Maybe background for our listeners. During the pandemic, they made a deal also with the U.S. government to sell some of their equipment. There was a high shortage of this. They started selling. Then suddenly they found an issue in it, like potential health issues. The FDA took it over and gave a negative recommendation. So Philips had to do a recall. Initially, they said it will cost us 250 million. No worries, investors. We will cover it already in our current guidance. And we know kind of already that this is BS, because this is not the first company that's happening. And over time, they've been giving just bad messages, bad messages, bad messages. And now suddenly in January, they act surprised that they need to reserve additional money. On top of that, there's nothing yet known about settlements, right?
Yeah.
So, and what really annoys me here is that the CEO here is really trying to upsell all of this, right? And it's just a mess. And what we see over and over again with European companies, that they don't know how to deal with the American watchdogs. Look at Johnson & Johnson, what they did with the talc powder and the opioid, how they manage it, right? Almost nothing happens. It's like I always said that the Bayer CEO should take an internship at Johnson & Johnson. I think Frans van Houten from Philips should join, and we should create a graduate program at Johnson & Johnson for CEOs that don't know how to deal with litigations in America before they enter the American market.
Yeah, but it's
yeah.
different cultures, though, isn't it? Like European and US, it's run completely different. I mean, you have the same product in both markets, and in Europe it's fine. In the US, it's not, and I believe maybe it's a little bit of arrogance on Europeans' behalf. They think that because it's okay in Europe, it'll just fly in America. It's just not the case. It's not the case. But I'm like you. I hope that they take notes from what Johnson & Johnson did, and just quash this, because honestly, and I think you mentioned it, they are going down the same path as Bayer if they keep this going. I mean, the hiding facts litigation will probably eat them. They're going to be spending a lot more cash on this, so it's worrying, particularly for dividend investors who rely on that cash flow. That cash flow will now be going to litigation lawyers and other people, so it's very worrying.
Yeah, the issue is that I noticed also on social media that people are taking a clue from the price action, because Philips was trading at 44 euro before, now at what is it, 28, 29.
29.
But
yeah,
you know,
yeah.
it's still at a PE, I would say, of 2025 if you take the real earnings and the cash flow, not if you take the adjusted earnings, which I analyzed over the last 5 years. They always have transformation costs in there, which are like from, let's say, instead of €2 EPS, if you take out the transformation, or if you include them back, let's say and deduct so that you have real profit, you will go down to 150 or something like that. So, you know, when does it stop to be a one-off transformation costs and restructuring cost? When? Yeah, that's why cash flow, that's why I'm so happy that Cameron is here, is a much better guidance, and because management can't lie about the cash, right? That's so nice about it.
Yeah, that's right. You can verify it. I mean, the auditors send the audit request to the bank that holds the cash and says, hey, management team is saying that at the end of the year they had this on their balance sheet. Can you verify it? And you get a third party that's saying, yep, that cash was in their account. It's a nice check.
Definitely. So yeah, that's about Philips, right? I think this, even with that, if you're, you know, you just watch out with this one. It's I think it's not done yet in this whole case.
No, not done. But hey, they weren't the only stock or company that took a little bit of a hammering this week. Our growth stocks, these stocks that were plastered all over my Twitter feed last year. I mean, I was made to feel really incompetent because I was not invested in these. They took a bit of a battering this week.
Well, yeah, and I think Shopify is a good example, right? I think Shopify is a really nice business. What it does for small businesses, entrepreneurs, I think it's amazing. But if you then look at the valuations, and I looked sometimes into them, I can't justify owning it. Still not at these prices. It went down 23% year to date. But if you go a little bit further than year to date, it just got hammered, right? And why I put this in the news in the week today, I saw on Twitter someone saying like, I'm going to sell my Shopify today shares and exchange them for energy stocks. And this feels to me like selling at the low and buying energy stocks rather to the high, because I mean, it's not like the oil price is now at rock bottom, right? No. It's already at $85, which is in the high end of historically of the last 5-6 years.
It's about 12 months too late, I think.
Yeah.
When oil was selling for $-, that's the time
exactly
to go buy the oil company. When everybody says oil's dead, is the exact time to go buy it.
So that was when EMF was buying, myself a bit in options, and yeah, we've done really well. But I remember that that oil is dead. That's what I heard. Why are you doing this? Oil is dead. EV, Tesla. Yeah.
That's
Good.
right. It happens all the time.
Yeah.
Okay, good. What we'll do then was we might move into the rapid fire round. Don't worry, these questions are not too hard. What I'll do is I'll just ask you 5 questions. They'll be A or B. You answer straight off the bat what you think, and then at the end, if you like, you can clarify your position or answers on
Adjust as needed. Okay, got it.
Okay, so nice and easy. First one, Americano or espressos?
Americano.
Okay. Arguing with your wife or arguing with your boss?
I'll take the boss. Argue with the boss.
Lululemon or Nike?
Nike.
Okay. Royal Dutch Shell or Shell?
Ooh, Royal Dutch Shell.
Okay. And last one is Coca-Cola or Pepsi?
Coca-Cola.
You struggle.
I'm not a huge fan of either of them, but I'll go Coca-Cola just because it's it's tough to bet against Buffett.
So explain us, what is it that makes Americano better than espresso?
I think it's the milk in there, isn't there? Is the I
No.
just no.
There's no milk in either.
Well,
So-
I guess I put milk in them. So for me, it's the Americano. I'll take. It's more volume, right? The espresso is just it's too small. It's like a little shot glass, and you're done.
Yeah. And
Yeah.
Americano is just an espresso with boiling water, pretty much.
That's what it is. Yeah, I like the volume of the drink because I drink a lot of coffee.
And let me tell you, the markup on them is incredible. So you might not know, but I ran a coffee shop for about 3 or 4 years just before the pandemic, and just for that little bit of boiling water, which is essentially free, you charge about 40 or 50 cent, which is incredible. So
Have you seen the videos of people taking Starbucks cups and take the large cup they have and pour it full of 5 different small glasses with ice, and one giant cup of their like tea will produce 5 cups with ice in it. It's
wow,
great.
It's madness, but
That markup works.
markup is huge.
That's
So
awesome.
I think that's a good intro anyway to maybe start getting in a little bit into the interview. So we'll start you off maybe with a nice, easy question. You said that you're investing from quite a young age. So do you remember when you started, and what inspired you to start at such a young age?
We got the paper delivered at the house when I was a boy all the time, and I would open up. I grew up in Los Angeles, as we get the LA Times, and it has a big business section. And I remember looking through all these numbers in the business section, just page after page after page of fine print, and just wondering, what is this? It's just visually very interesting. And then as I learned that these were actually prices that I can buy companies that I liked, I was curious. So I asked for a share of Nike and a share of McDonald's for my birthday one time. That's all I wanted, and
Wow.
and I got it, and I didn't know what to do with it after I had it. I was like, I had a stock portfolio. It had 1 share of McDonald's and 1 share of Nike in it, and I was, I don't know, 11 or 12, and
Wow.
it's just there. It sat. I didn't do too much with it, but it was interesting to have it and start thinking about what that meant.
So that would
And
have
do you
been
still own?
sorry, but that would have been before online brokers. So
Yeah.
you would have had to physically go into a bank and get that piece of paper.
Yeah, I think I paid as much in commission as the share was worth. It was like $20 commission for a $25 stock.
And do you still own them?
No, sadly, I got rid of McDonald's and Nike because I don't know, at some point I got older. I felt I knew what I was doing, so I had to start trading, obviously, because I can make a lot of money by bouncing from one brilliant idea to the next. And you realize that doesn't really happen. And maybe I should take a step back and look at the long game. So that's a good.
And I mean, what how is it? Can you explain then a little bit, like how that went? So you were 11, 12, your first shares. Was this then a ritual every year? And when did it really become serious for you, in the sense of that you saw like, okay, hey, this is becoming serious money, and yeah.
Yeah, so I would ask some relatives for some cash for stocks. I had a family friend that was really into it, and so she helped me kind of lean in a little bit. Every birthday, she'd give me $100, and I would go buy a share. And over time, like I got distracted as a kid. You go do what you're going to do as a kid. It kind of clicked along, but you would look back on that, or I would look back on the account and think, oh, it's growing. This is really interesting. Maybe I need to learn more about what this means and why did it move up or down. And that led me to be a finance major in college. If I can just fast forward, and from there, I really got to understand the math and the science behind it, and what it meant to run a business and how they can last for 50 or 100 years, and that longevity really made me curious. And I continued to try to learn more and try to invest more. And I've bounced around from different strategies over my lifetime, try to figure out what fits me as a person, like what gels with my personality the most.
And what is
And
it today?
I'm trying to be a buy and hold. It's tough in this market because it's so you get so much media pressure to go do something else to get you to act and engage. But the more I read about really smart investors that are much older than I am, the more I learned that they make, you get a couple opportunities to make good investments every so many years. You don't have to make a move until it's clearly evident to you that this is a great deal, and you buy it and you hold it for a long time. And those people hand hundreds of millions over their generation because they made one good move and they didn't touch it.
Yeah.
I'll tell you a brief story. So part of your question earlier about putting money away and then what happened to it, I forgot that I had a Roth IRA years ago. I bought some shares of Apple because at the time it was an interesting stock and people were running around with the headphones. Here you go. And I forgot that I had the shares entirely. And I think a decade later, I looked at the account, it was up massively. And I never touched it, never added money to it. And that to me was eye-opening, because here I was thinking I was a finance major and I knew what I was doing. I was trading and doing all kinds of fancy moves. And then this other account that I bought and forgot about was outperforming whatever brilliance I thought I had. So that to me was a nice kick in the teeth of like, hey, maybe all this movement isn't actually progress. And I should go just slow it down. And that's when I started looking more into a real value investing strategy, and how do I position something for a decade or 25 years from now.
It's really interesting that you mentioned that, because I've got kind of an MBA as a background, so I got all the finance courses,
Yep.
accounting, and what I struggle with is actually with this. You when you understand the information, you are subject also to getting sucked into the information, and therefore lose kind of the helicopter view, right? So what I'm really trying to work on is to become a bit more streetwise when it comes to investing. So really sensing when this is indeed a good buy. Of course, you need your data here. And what I've learned actually, that there's every year there's one stock or something like that I've got conviction around, but it's usually just one. So last year it was Ahold Delhaize as an example. The year, I think in 2018 it was AbbVie, which was
Mhm.
trading around 60. And do you have some similar experience like that? That is really like a small amount actually every year where you have some conviction around?
I think that's right. I mean, for me, Facebook was one that I looked at. I remember watching it. It was always trading at a premium for a long time, and I just couldn't get over the multiple I have to pay for it. And then
Mhm.
at one point, Mark Zuckerberg gets called in front of Congress. This is actually only a couple years ago, and it gets a lot of negative press, and the stock starts collapsing. And I remember looking at that and thinking that this is all PR, and no one. It's still a massive cash machine that's
Yeah.
globally diverse, has zero debt. I'm like, why is this thing going down? So I ran over to the bank and I borrowed a bunch of money, and I drew on a personal line. I said, you know what, this is really interesting. Let me just go and make a bet, and this is my bet for the year. And
Yeah.
that worked. That worked out really well, and I liked that strategy of waiting around until it's clearly evident that's a great deal,
Yeah.
and then go make a move.
And how does that work then? You go to the bank and you say, I want money so they can buy stocks. And how do you feel comfortable with that?
In that particular instance, I was already 100% in the stock market. I had no other cash that I
Yeah.
could put in. So I needed kind of an immediate loan. I went to my bank and said, "Hey, this is what I want to do. Yeah, I want to put in the stock market." And they're like, "Okay, how much do you want?" I'm like, "This is what I want." And I got
Yeah.
the cash and I went and bought the stock. Um, I don't know if I would recommend that to everybody, but in that instance, for me, the risk, the reward dramatically
Mhm.
outweighed the risk of the borrowed funds, and I had the cash flow to make the payments. I'm like, let's do it
Yeah.
and see what happens.
So would you say Alibaba was at that space?
I've rebought twice now, so I hope it works. It's
Yeah.
slowly growing actually rapidly growing as a piece of my portfolio because
Yeah.
I liked it when it was a whole lot more expensive. I still like it now, and I'm gonna sit there and let it do its do its journey.
Yeah, super. I'm a average price of 170. So for
Yeah.
me, but also thinking it could go to 300 over the next 5 years. So that's what I'm hoping for.
Yeah, I mean, you look at the company, you look at the market in China. It's massive. I don't think the Chinese are going to kick out foreign investors. They need that capital infusion to grow their
Hmm.
country. They are repositioning the profits of that business a little bit, right, to benefit everybody. But that's just like changing tax rates,
Yeah.
and so I don't see that as nationalizing a business. I see them as just increasing the tax rate on a company that's got very little capital cost and a high profit margin.
Yeah.
Okay, I'll do that.
And what one of your trademarks is really to look also at the company as a stock as an enterprise, right? Could you share a little bit like how you're really looking at stocks, right? Are you buying businesses or are buying stocks as an example?
Yeah, it's a great question. When I'm pitching for an acquisition for a company that I work for, right, we're buying the entire enterprise, and you typically in an acquisition you buy a company on a debt-free, cash-free basis. So whatever debt they have existing when you acquire them, you're going to pay it all off, and you'll put in your own capital structure. And I like looking at a business that way. It helps to wash out some of the noise of how they finance their business. If they have a lot of debt versus zero debt, it can impact earnings per share. It can impact growth rate. But if I remove all that and say, let's just look at the enterprise itself, what are the total cash flows of the business, and are those growing? Then I get a clearer picture of where I think the business is going to go.
Hmm.
For example, like a McDonald's or a Pepsi we discussed earlier. Those companies have a lot of debt, and they have been growing that debt over time as they try to buy back shares to boost their equity price. They eat on a per share basis, and
Yeah.
that's not growing a business. That's just manipulating the math to show people that focus only on a share price that number is growing.
Yeah, and then we see this probably, and this may be also nice, like a nice switch also a bit to dividend investing, because we see this, of course, also a lot with dividend investing. So our audience is really curious about your thoughts about dividend growth investing as well, and how you look at that probably from a capital allocation point of view as well.
Yeah, so I think I first started at cash flow, right? So back up a layer. In order to have a dividend, you have to have the cash flow to meet it. The dividend is a decision that the board makes on how much they want to pay out. So if free cash flow is strong, is growing, then they can afford the dividend. Then I think it's a great investment. If they get, what I'm seeing is some of the dividend aristocrats get married to the dividend. They can't change it, right? AT&T is a great example. They're
Yeah.
paying out a massive dividend. They could barely afford it. There was no room for error. Something happens in the capital markets. They're like, they can't afford it. They're like, oh, I have to cut the dividend. And the share price is massively hurt because everyone was buying it simply for the dividend.
Yeah.
So I love dividend investing, but I would say make sure that free cash flow first is strong and growing, and the byproduct of that is a nice dividend you can rely on.
Yeah, and I think what you're speaking about there is there's a difference in dividend investing and dividend growth investing, whereas dividend investing is chasing maybe high yields and companies like AT&T. Dividend growth investing, I mean, we focus on cash flows, revenues. We focus on these things, so they have a safe, sustainable dividend that can grow. I mean, if they're not growing their top and bottom line, they can't grow their dividend. I mean,
That's right.
they can't grow it. So I think that's why our focus is primarily dividend growth investing and not just dividend investing. I think that's one of the key things we like to put across out there.
Yeah, you can get burned pretty hard chasing yield. Like if you just take a simple screen of stocks and just rank by the highest dividend yield, and someone's paying 11% dividend, it's probably not going to be paying for that for very long.
Yeah,
So
we have experience with AT&T in the community where it was like buy AT&T on the 30. Yeah, this
yeah,
was such a clear sign of yield chasing. Then it was buy AT&T on the 29, and I think then it stopped because people started to lick their wounds, right? Yeah, for me, AT&T is a really interesting case because it was written on the wall that they had to cut it, and it was not because of the dividend or something as such. It was just mistake after mistake after the mistake with the acquisitions, then actually kind of lying to investors, right? By saying that it's all good and opportunities and. But if you took the clue from the cash flow and the debt levels, it was clear that the dividend was not sustainable, and they had to do something also with the spin-off.
yeah. Remember that CEOs are salesmen to some degree. Like they rely on, they obviously earn their salary from the company they're working for. They have shares in that stock. They have a vested interest in making sure that the stock goes up. And that can be detrimental too. Like they could not want to give honest, real guidance because it's going to affect their personal net worth or their job. And there's a little bit of you have to step back a little bit and realize that sometimes they're talking to you and it's a sales pitch. It's not what is likely to happen in the future. It's what they would like to happen in the future.
Yeah. This is also always so tough for me because I think when I look at Wall Street and if I look at the news and the headlines, they're often just parroting those headlines, right, that come out of the press releases. And how do you deal with that yourself? Because there's so much you can analyze on a day, and look at. So how do you deal with that yourself?
It's very hard. It certainly with social media growing as fast as it is, there are a lot of people that are publishing articles for just the clickbait. I think I saw an article on Twitter the other night. It was Palantir, and it had fallen down, and this article was basically quoting Buffett that when people are fearful, you should be greedy, and that quote, and relaying it to the drop in the price of the speculative stock, and so therefore it's a buy because it's gone down. I'm like, this is just a clickbait article that someone published.
Yeah.
And what I try to do is that's why on my channel I look at 10 years of financial information and I lay it on the screen. It helps smooth out all of the noise between 1 year to the next, 1 quarter to the next. It smooths all that out, and for me it becomes much simpler.
Yeah. And for the retail investor, I mean, you spoke about clickbait, and that's only targeted at retail investors. There's no institutional investors reading that kind of bullcrap, I'm going to call it. But for a retail investor, what do you kind of wish then that they would understand a little bit better, so they're not clicking into these headlines and not getting caught with these?
I think if they can try and understand what the value of something is, and then realize that the price on the screen is different from the value. People say that the markets are efficient, and I do believe they are, but they are also highly inefficient for long periods of time. And just because someone's offering you the shares of a stock for a particular price doesn't mean that stock is worth that. And if you equate it to maybe a pair of shoes and said, how much would you pay for these Air Jordan shoes? They would probably they'd be easier to tell you the value of those shoes than the stock price.
Yeah.
And that's probably just an education piece.
And does this kind of looking at value, how do you then look at gold and Bitcoin or cryptocurrency? That's hard, right? As a value investor.
Very, very, very hard. I read that Bill Miller has like 50% of his net worth in Bitcoin, and I was scratching my head. I didn't know why he would say something like that or do that.
Yeah.
It's very hard to value.
But you use EBITDA, don't you, when you're valuing? a company, and we all know Warren Buffett was not a fan
He hates it.
of this whatsoever. I know we have a quote out. He's not a fan, but why do you use this then? Why do you use EBITDA when you are valuing a company?
Great question. I do two things. One, what is the free cash flow, right? So I look at that every single year, and then you're right. I use EBITDA to benchmark as a relative metric to the enterprise value of the company. Enterprise value divided by EBITDA. Two reasons. One, lots of companies the finance industry as a whole runs on EBITDA, for better or worse. That's the metric they use when they report acquisitions. So if Johnson & Johnson were to buy a company, they'll say, hey, we bought this company, we paid 10 times EBITDA. So there's market data coming to me about rational investors making acquisitions and reporting on a multiple of EBITDA. So that market data I can take and say the market is paying 12x EBITDA for this business. I can take that as a data point and then apply it to the companies I'm looking at. And I get just a broader spectrum of people valuing businesses off of that metric. And that's why I use it as one of two methods that I look at.
Yeah, and then often we see, for me, it's always like really funny. Then we have people also reporting adjusted EBITDA. How do you look at the term adjusted in itself? Yeah.
Yeah, I mean the adjustments are supposed to be when you're buying a business, you're paying a multiple of EBITDA, and someone will say, well, last year I had this issue. It was clearly one time. And, you shouldn't allow that to lower the value of the business because you're valuing it based on forward cash flows, not last year. So I want credit for it. And they'll argue for, hey, add that back. And that's fine. It happens all the time. If there's some sort of, I don't know, like a regulatory issue or like, say, a legal settlement, if you had to pay a legal fee, it's one time. But when people
unless
start
it's a
adding
legal fee every year because of
exactly,
how
yeah.
they manage
So
the business. Yeah.
Totally, exactly right. If it turns into this annual problem, then that's not an add back. That is your business, and it needs to be removed.
Yeah. Good point. And I know we're now a little bit technical here, maybe for some listeners, but there was also really a particular question around free cash flow. And the question was like, why do you use free cash flow for equity over, I guess, the more normal or popular free cash flow? And maybe you could start a little bit explaining in 1-2 sentences what free cash flow for equity is as well.
Yeah, so the free cash flow to equity is the free cash flow. So operating cash flow on the cash flow statement. What do they make when they run the business from year to year? Less your CapEx, the money you have to put back in the business to grow it, and then plus or minus any debt changes that you made in the year. If you add all that up, you get free cash flow to equity. That is ultimately what we're buying as equity owners. The other cash flow would be free cash flow to the enterprise or to the company level, which basically doesn't account for the debt. It's just basically cash flow from operations less CapEx.
And I guess in your business, when you're evaluating companies, you're looking at the equity part because of acquiring and not necessarily. Yeah, you don't want to take the debt into consideration because it's owned by the bank, I guess.
You kind of. So if you have a company that's really highly leveraged and has to make really big debt payments every year,
like AbbVie, yeah.
I'm not too familiar with that one, but
okay,
or
AT&T.
There you go. Yeah. And stick in the States, it's easier for me. But you're right. If you have to make significant debt payments every year and you use cash flow to the company, then you're excluding that entire payment that's mandated by the banks, and they would repossess the company if they stop making it. You're excluding that cash outflow in your numbers. And it's something that in this market, the way we are, as low interest rates, as low as interest rates are, and the amount of money people have borrowed, we really need to take that into consideration.
Yeah. Good. So I think we will get back to some more questions from the listeners soon, but we also would love to hear a little bit about your YouTube channel. So
thank you.
Happy
to, yeah.
How is it? Do you also see it as a business, or how is it for you? Maybe the whole journey and yeah.
Sure. So I started it actually in March of 2020 with the collapse of the stock market. I thought it was overdone, and I thought, I'm gonna lean in, and I borrowed money, like I was saying, and was buying stocks. Why don't record this journey? And so I started putting videos out there, and I was very surprised by the feedback I got, the questions I got, the comments, and I said, well, I'll keep doing this. It's not too hard, and it has it's grown into a community, and I've really enjoyed talking and reflecting with these people that are like-minded with me. They're just trying to buy safe investments that they can hold for a decade, and I'm really enjoying chatting with them. It's not necessarily a business for me. I have my more than full-time day job with two small kids, and it's like just finding the time to do the channel. It's been a lot of work, but it's fun for me to put out a forecast, watch what happens over a couple of years, go back and watch that video and say, was I right? Like that is very humbling.
Yeah.
And I've learned a tremendous amount from the viewers that are smell checking these numbers, and they're saying, hey, you missed this, or what about this issue? And that to me has been so rewarding and humbling. I really, really appreciate it.
And do you think then that your colleagues at work treat you a little differently at all? I'm kind of curious with this one because I know we're kind of in the background here, but I've started to put my face a little bit on YouTube now, and nobody in work really knows what I do. So I'm just kind of interested how they take you where you work.
Most people think it's great. In fact, all people, they're like, "Oh, this is amazing. You definitely belong in YouTube. I'm so happy you're doing it." That kind of thing. It's been very positive.
Good.
And the wife?
She likes it too. She thinks it's hilarious to see, the boy. I mean, we've been together for a long time. She's like, this kid that I knew in college is now doing this. She just laughs at it. It's fantastic. She makes fun of me
And,
more than anybody.
and I believe you have like 40,000 subscribers, right? So
Yeah,
that
we're
means you're
coming
really
up
an
on it.
influencer on YouTube now. Yeah.
We're coming up on it. I started out of the channel. I started a website called cashflowinvestingpro.com. And there I started teaching a course for the people who really wanted to learn how to do it themselves. Because I found that I was getting so many requests for stocks, I couldn't possibly do them on my own. I was like, well, I'll create a course and let people learn how to do it. And that has been amazing. The amount of people who have purchased the course is overwhelming interest. The feedback has been phenomenal, and I'm really happy that we can teach people to do this on their own, and hopefully that will then carry on to their future for 20, 30 years. It could help change the course of their investing career. That's what I want to do, is help people get where they want to go.
Yeah, I can only say from having watched many videos that for me you're really a multiplier. And you mentioned the term humbling before. It's also visible on screen when we were watching at you. And I just think like you deserve a zero behind your subscribers base, because there's
Thank
so
you.
much crap out on YouTube that is like just pumping stuff and driving fast cars on the background. And I wish that.
It's garbage.
Yeah, exactly. I wish they would tune in a little bit more to you. So we'll for sure put the links with when we release the podcast and everything, also to direct them to your channel.
I
And
appreciate that. I really do.
sit, notebook, and learn. Yeah.
It's awesome. Yeah, I like it a lot.
Cool. So what we might do then is move on to some of our listeners' questions. We got quite a few, so we'll get through as many as we can.
Awesome.
And we see how we go. So the first one, as you can see, is from my buddy Martin, and he wants to know how you rank the following. So how you rank revenue, earnings, cash flow, and dividends.
Well, cash flow is number one. I would say earnings are number two. Revenue 3, and dividend is 4.
I had a joke with him. I had a joke with him before. I said, if he puts dividends last, we'll cut the show.
Yeah, well, we'll just put a beep. We just put a beep in the show. This is unacceptable. This is like, oh my god.
but honestly, I would agree with you. I would agree with you.
Yes,
in that order.
me too.
Yeah, I was gonna say, let me caveat that's basically that's the byproduct of all the other goodness that comes out of those other numbers.
Rafa has asked us any interesting pick in the industrial sector where you see value at the moment.
The industrial I don't I'm less I don't know, nothing specifically that's calling out to me. I've been looking more into still the like the e-commerce space. I'm still interested in this work remote kind of change that's happening in the world. I think that's really impactful, letting people like you and I have side jobs, have main jobs, and then do a side hustle. I think that's going to happen more and more to people. And I want to be in companies that are, selling picks in a gold rush kind of thing.
Cool.
Yeah. The industrials that I know, EMF, like 3M, Siemens, even General Electric. Maybe General Electric is probably your best turnaround play at the moment. I mean, I love the CEO, right, from GE that they have currently. It's my biggest loss as well because Jeff Immelt was in the early days that I still bought what the CEO said to me.
Mhm.
So, but it's Larry Culp, I think he's amazing what he did with Danaher. But from a dividend investing point of view, I see nothing at the moment. Industrials you want to buy at the bottom of a market cycle, not now.
Yeah. And Rafa had a follow-on question as well. He just wants to know what your top 3 holdings are in your portfolio.
Yeah, so this is probably out of the growth that I've received in those stocks. But Google, Facebook, and Wells Fargo are my kind of top 3. Like I said, mainly because I don't want to sell it, and it's growing, and it's going to be a bigger piece of my portfolio.
Wells Fargo is really interesting because I've been watching the C-SPAN live recordings on YouTube when what was his name again? When he was in Gibbs, he had his arm broke, Stumpf or something like that. The CEO.
Yeah. They need that company still needs work. I wish I'm not going to get out of it. It continues to sit there. I'm collecting the dividends. It's doing its thing. So I think that's just more of a legacy position for me.
Yeah. Nice. But hey, if you bought it at the time, like you mentioned with Facebook, you actually, really did the value investing there, right? Because it was just hammered.
Yeah, I bought it at the financial collapse of
even better.
of the 2008. So I got it for like $15 a share.
Wow. Nice.
Okay. Dividend MVP loves your YouTube channel. He would love to take up your course. He's just unsure about his level of knowledge, but he's keen to hear your thoughts on dividend investing. And I know you gave an overview of that already.
I think it's a smart way to go, honestly. If a company can afford to pay a dividend, you get a little piece of that money back. It's a great style. My next video coming out is going to be an update on the Domino's versus Google IPO video I did a year and a half ago. Domino's has returned 5,000% since its IPO in 2004. Google has returned 3,400%. It actually beat Google. So if you put $10,000 into Domino's at the IPO in 2004, it'd be worth more than $500,000 today. Wow. And because the dividend and reinvesting the dividend in the shares led to that is one facet of the return. You got a market multiple expansion from like single digits to now 26 times multiple earnings. So you bought it IPO at 7 times earnings. It's now 26. That helped. The dividend allows you to continue to buy shares at a cheap rate. And those 2 factors, plus some earnings growth, those 3 factors, I call it trifecta, they combine and you get a parabolic return that just smoked Google.
Wow. And Cameron, invitation to consider. I did a poll the other day on Twitter. I think less than 5% has $10,000 to invest in a single stock. Because we always say like, 10,000 invested in 1990, and then everyone's pulling their heads out like, who had $10,000 on the shelf? Yeah,
fair enough.
Who has it even today? So
fair enough.
I started to work with €1,000 or $1,000. That
fair point. But I think it's all relative, right? It's 10,000, $1,500. It's the idea of, hey, you put the money in the bank, in the stock, you let it sit there for a long time. One of the one of the big lessons for me when I started trading after I got the finance degree, and I thought I knew all these metrics, and I got kind of paralyzed by all the numbers, is you end up paying a lot in taxes as you buy and sell securities, especially if you hold them for less than a year in the States. You pay what could be ordinary income tax, and they're taking 30% of your gain, which means you have to start at a lower number. So it means that when you sell, you keep less than you think, and that money, just to get back to where you were prior to the sale, has to work harder to grow your money. And if you simply do nothing, oftentimes you are better off.
It's the story of the turtle and the rabbit. What is it?
Completely.
This little fairy tale. Yeah.
Completely.
Okay. Dave has asked us a couple of questions. His first one, which I'm interested in, is what is your favorite whiskey, or do you have one?
Yeah, I like single malt Scotch. So I like Lagavulin. I like a lot. There's a company called Oban in Northern Scotland. I like that distillery. Mostly the peated stuff. I would love to get the island of Islay, get over there. I've been to Scotland a couple times.
We've got some nice. I got a bottle the other day as a present. MVP. It's Middleton, very rare.
Okay.
Oh man, it's amazing. It's amazing. I'm surprised I'm not drinking it on the show, but I couldn't today.
I'd like to get over there again this summer if the COVID restrictions open up. I'd love to get to Scotland.
Nice. And the second part of the question is, which company is giving the best 10Ks to analyze, in your opinion?
Good question. I like Costco a lot. So not only do they need to have a clean income statement, balance sheet, and cash flow with solid notes, but I like operating statistics underneath there that explain why the numbers are moving. So Costco does an amazing job. They've got this waterfall chart that shows the average, I think it's average revenue or average earnings per store per year. And it builds over time. And you get a very good idea of how each incremental store, how much value that store adds to the portfolio.
That's transparency.
It's great.
Yes.
And Chipotle does a little bit. Like Chipotle will show how many stores they've opened and so on and so forth. But having businesses give the underlying metric is in my opinion foundational to analyzing a business.
Cool. Future Dividends has asked us, he is low on financial weighting in his portfolio, and he's worried about banks. So he's looking for a non-bank financial dividend growth idea outside of Visa and MasterCard.
Oh, non-bank. Geez. What about is like a BlackRock kind of a non-bank entity, or is that it's a private equity business, but it has a dividend to it?
Yeah.
It's a financing entity that buys and owns businesses.
BlackRock or Blackstone, yeah, it could be two good ones.
BlackRock has an amazing dividend growth, by the way. We analyzed the dividend day the other day one time, and it's amazing, BlackRock. I was also thinking about maybe PayPal, but I honestly don't know where it's trading at the moment.
I like PayPal. I own it. It's fallen a lot recently. It might be interesting. PayPal owns Venmo, and there's a lot of transactions on that, and that's probably a pretty decent stock.
Cool. So Martin just wants to comment to say how good your YouTube channel is, which is always
Thanks,
nice to hear.
I really appreciate that. I really do.
Tom has asked us, is there any stocks on the London Stock Exchange that look interesting? He's already given us probably all the best ones. So he already has Unilever, British American Tobacco, Diageo, Chesnara, Rio Tinto, and Royal Dutch Shell.
I want to look at Rio Tinto again. I haven't done a review of it. The tobacco companies make a ton of cash. And then I don't know any more that outside of that. One of the things I'm trying to do this year is widen my scope and look outside the US a bit more.
So Diageo is a huge alcoholic drinks company. It's a good place to start.
Yeah, they own Johnny Walker. It's a great one.
And Guinness.
And Guinness.
Thank Guinness.
Yeah.
By the way, if you want to ever read the best 10, the annual report ever, we'll share your link. It's Van de Velde from Belgium. I mean, if you watch it, just don't put it on your night shelf because your wife will be jealous. It's literally annual report, which you could consider a soft porn magazine because they sell
awesome.
underwear, and it's amazing. Anyway, regarding to London, what is interesting is that he didn't mention BP as an example because
Yeah.
it's oil, and BP has the longest reserve life of the 5 oil majors. And I think they are one of the best values typically from the 5 oil majors. So BP would be a really interesting one in this regards. And one of my favorites would be Spirax Engineering, but it's still overvalued. But this company is a powerhouse also when you look at dividend investing. And I hope this one comes much more down. And there's also a holding company. It's called, I forgot. I'll get back with that name. But it's kind of, I'll get back with the name. It's part of the European Noble 30 list as well. It's in there.
Okay.
BP is probably a good one. I own that briefly. That'd be a good stock too.
Okay. Phil has asked us, where do you see more growth potential in 2022, and the same with value? So he's asking in terms of American and European stocks. So do you see more growth potential in American or European stocks, and then the same with value?
Who knows what tomorrow's going to bring? And that's the thing. I mean, you nobody knows. You buy a company that has great historical track record, you believe in the management, and you let them make great decisions for you. You just don't. Nobody expected the pandemic to happen, and here we are 2 years later. We're still living in it. So too much uncertainty. I can't.
And then countries are, by the way, declaring. I think Spain started to declare the flu now. I mean, our Spanish listeners will know, but they start to declassify it and towards a flu. So good news, by the way.
Yeah, we're having a lot of. So there's kind of a divide in the United States right now. You've got the predominantly red states, like the limited government, kind of more Republican people states, and you've got the bluer, the more Democrat, the more social states. And there's a divide between the two of how to treat COVID. And the red states are just like, you go do whatever you want to do. If you want to wear a mask, go do it. The blue states are mask all the time. You can't operate your business. And there's it's really interesting to talk to people in different states and get their take on it. I'm not seeing any of the death rates be a problem in any states that are just operating freely. I will say that when I look at acquisitions in the red state versus blue state, there is a beginning to be a premium that people are willing to pay for red state stocks versus blue state stocks, because they think that the red state stocks will stay open if there's another pandemic, whereas the blue states will lock down and you lose cash flow. So people are starting to be cognizant of the political impact, and they're beginning to pay a premium for states that let you operate regardless of kind of how COVID affects you.
So that makes ExxonMobil really interesting.
Something to consider. It's you have to be able to run the business to make cash flow.
Exactly.
Interesting. Blue Nexus wants to ask you about private equity firms such as Apollo, KKR. He's interested in these, but none of his sources maybe cover the sector.
Yeah, I mean, those are two of the huge players. I think I said Blackstone earlier. I think I said BlackRock, but I meant Blackstone. Yeah. Those guys can be very good. They're very hard to judge the value, right? Because it's not a sustainable business machine. It's not making widgets and just stamp out widgets, and it's easy to map out. You are basically putting your money with money managers, and you look at their track record, look at what they currently own, and you're just trusting them to continue to make good decisions. I would say, just in general, my exposure to private equity people has been that they absolutely love economic downturns. That's when they get the cheap. That's when they can really put their cash to work. And so you want to wait for a collapse in the market, and then you say, "Oh, okay, now I'm going to go buy the Blackstones, the KKRs, because those guys are going to cherry pick the best of the best in the private sector, and you'll get that exposure."
It's good advice. We have maybe European DJ can pronounce the name.
Gonzalo.
That's it. Gonzalo Pinto. He is curious about your portfolio structure. So, do you focus purely on value investing, regardless of it being a dividend or a growth stock?
Yeah, I'm primarily interested in the 5 key attributes that I go over the channel. Are they growing revenue? Is the enterprise value, is the enterprise earnings growing? They have low debt, hopefully none. Do they have strong free cash flow and are they well priced? The dividend for me is a byproduct of that.
And sorry, he just asked the second part of the question, which is what is your favorite dividend stock in the current market?
I like IBM a lot. I own it. It's got a great dividend. The software is incredibly sticky. I think the guy that's turned it around, I'm going to give him some credit to let him run for it.
Oh boy! Oh boy! Oh boy!
No,
For me, it's a failing business in every segment. They lost the whole battle on the cloud. Their software is inferior. Red Hat is too small of anything meaningful in IBM, and the CEO is a clerk. Yeah.
I'm actually so happy you said IBM because we could just sit back. We could sit back now and European DJ will
this
rant.
fight.
Yeah, he
We,
will
we,
rant
we had
for
a
20
whole
minutes.
podcast about how to recognize a declining business, and we used IBM as the case study of this, where they're financially engineering, right? Because their their earnings per share, I think, were $14 or $15 a decade ago, and
Mhm.
only went south. Yeah, and all the time, like if you take every time the first press release, do that just for fun, right? When you're drinking a whiskey. 5 years ago, it was IBM Watson. Then it was
Yes.
blockchain. Then it was this. Then it was that, and everything they failed on. Everything they were failing on. Yeah, so now they spun off the business in Kyndryl, I believe. It might be their ticket out, but I think many people that I've seen in the dividend community have been for 5 years in IBM now, investing for the dividends, but
Yeah.
also expecting share price appreciation. And yeah, so my opinion is avoid at all costs.
No, I love the opinion. I was thinking that, they are going to be breaking off business units to try to focus the cash flow that they're generating onto the highest return project. And I hope they can do that. I hope that by selling off some of those assets, they can do that.
Yeah.
It sounds like you don't believe so, but we'll see what happens.
We'll see what happened, but it reminds me more about the opportunistic management of General Electric in the Jeff Immelt days. That's what it reminds me, and and when you see the numbers, you see similar patterns. So for me, then there are so many other opportunity costs. And you did an awesome video on Microsoft, right? Microsoft was also going through a decade of struggling, like Windows versus MacBook and this kind of stuff. But then Satya Nadella came in and he changed the culture. And because he changed the culture, the business improved, right? What I really liked about Microsoft is before it was like everyone is a competitor and an enemy. And Satya came in and said, no, we serve an ecosystem and we're going to work with and collaborate with this ecosystem. I haven't seen this yet with IBM. Yeah, I see it with Intel, by the way. Intel is having this approach now with Pat Gelsinger. So, for instance, Intel, I wasn't bullish with the former CEO, with John Stenke. And now with Pat Gelsinger, engineer at the helm, he understands what he's doing. And you can sense that, you can feel the energy, right, around Intel.
I agree with you on Intel. I still think that is a great play as well.
I'm so happy you said IBM. I really am. So moving on, Catalan dividend investor. So he wants to go a little bit off topic. He wants to know our view on renting versus going into a mortgage from a dividend investing for financial independence point of view. There's obviously opportunity cost in building equity into a house and owning it.
I guess it depends where you're buying the house. In the U.S., the government really subsidizes the price of a mortgage, and your ability to buy a house as your first time home buyer takes very little cash down. And I think if you're reasonable about your living standards, and you buy a place that you can very easily afford, then buying a home is a great way to leverage yourself into a nice bit of equity. And over time, certainly at the inflation that we're seeing, if you would have locked in a fixed rate mortgage, and now inflation has been going 7, 10, 15% annually, depends how you look at it, that is affecting your home price, but your mortgage is not saying it has not changed. Whereas rent is going to go up with the inflation.
Yeah, I just shared a graphic. You both might be able to see it in the document that we have. But Europe is so diverse with house prices and rents, and depending on where you live, your answer could be different. Like for example, Ireland, where I'm from, you can see that rent prices have far outpaced house prices going up. So the rent is ridiculous over here. It's going up at a pace that's nearly unsustainable at some point. And it might make more sense to buy a house. And then you look at Spain, Cyprus, Italy, and you see that rent hasn't really gone anywhere, hasn't gone up, but house prices hasn't either. So it might not matter if you rent or buy in those countries, but it completely depends on where you are, what your goals are. For me personally, it was about security. I don't add my home in my fire calculations or anything like that. I have a young family. Their security is way more important than whatever I'm going to do in the future. So that's what I bought a house. But I mean, all over Europe, there's different cultures based on, as you can see, different rents and house prices.
It'd be interesting. The other aspect here is inflation, right? The European Union, the U.S., they're printing funds, and a great way to maximize that is to borrow a fixed amount of money and pay that back with a diluted money in the future. That's essentially what people are doing with buying a house. They've been doing for 100 years.
Yeah, that's what I've been doing as well. I've decided not to pay down my mortgage, although I could, because the opportunity costs of
Don't.
just Johnson Johnson pays me already more.
Absolutely. Don't do it. You buy a conservative, well-yielding, financially secure business. It's going to be there, and you'll be better off than paying down your mortgage. In my opinion, not the side advice.
Exactly.
I pay down on my mortgage as well to keep the wife happy. I mean, she doesn't understand investing or the maths for my wife. I have this huge amount of debt. We need to pay it, so it will keep her happy, her peace of mind, that if we say, okay, we pay X amount off every month extra, and I take X amount and invest, so we're both happy.
Hey, happy wife, happy life. You gotta keep the balance.
That's what they say. Yeah, that's right, and I'm trying to do that.
But EMF, you just accepted a house extension. Come on,
Oh, stuff. Yeah. So you might notice my background is blurry. So this was my lovely, nice office. We're now getting an extension up the way, so it's been pulled apart. But that's costing me money. That's look.
So show her some in the evening. Say, wife, here's a red wine. Let's watch Cameron Stewart.
That's funny. I got a lot of friends who said the same thing to their wives. That's funny you brought that up.
Brilliant. Okay, so Div Collector has asked us, what do you think of JDE Pete's? It's a relatively new stock which has to prove itself, but it has a nice dividend of 2.6%.
I can answer this one.
Good.
It's effectively, as far as I remember, it is owning Douwe Egberts brand, which is a large coffee brand, also worldwide. They sell a lot of coffee, so you could consider it a competitor, as I said, from Starbucks. I'm not 100% sure, but I think they don't do retail in the sense of direct to consumer. Look, it's too early out here. So from a dividend investing point of view, I don't know yet what the reliability is of management when it comes to dividend growth. As an example, it is having a price to earnings of around, let's say, 15, I believe, at the current share price. It sounds like such a nice compounder, but I would need to do more research to really understand the company. And there's just not enough information out there for me to make a judgment call here. And there's a long history around this coffee brand and the company, which dates back like a few decades probably already, and it was private equity in between. And so this here you really need to watch out also with the debt load and all these and they have a lot of debt load. I think their long-term debt to cash flow is, I think, a multiple of more than 10. So I'm talking about free cash flow, let's say, being 500 million and then the debt 5 billion, something like that. So it takes probably quite a long time to bring this debt down.
Yeah, if I look at it just really quickly on Yahoo Finance, again, it's not diving into the 10K, but the cash flow from financing activity is as much as the operating cash flow. I'd be leery about the amount of debt they have.
Yeah.
Cool. That was the last question, which is good. So, and this part, we usually take a stock pick, one of the two of us, but as our guest, we give the honors to you to maybe, it don't have to be anything, just maybe your favorite stock, or it's not a recommendation, just kind of your favorite stock. What would you pick?
Sure. I'll pick Microsoft, because I just did the review of it, and I really liked, even though I do think it is richly valued at this point, but their earnings continue to grow. It's a beautifully sticky product. I'll give you an example. They have a enterprise software, their accounting system, and as a CFO, if I'm running Microsoft's accounting system or Oracle's or whomever's, you are not going to change that system. And if the economy goes down, in order to run a financial, I have to pay Microsoft so I can get the license to just turn on my financial system. They're one of the first people I'm going to pay, along with employees. So it's like that stickiness, in my opinion, is amazing, and they make a ton of cash and have low debt.
Yeah,
I like that stuff.
And I mean, I can only echo and even further, right? If there's a market crash, where do you go to if you get fired? You go to LinkedIn. Yeah, so
right.
they own the whole ecosystem. For me, when I was thinking, and maybe it's a nice video for you, it's the perfect stock for widows. If you're thinking now about if I would die, and it's a question that I have sometimes, right? I know my wife will not be able to maintain my portfolio.
Mhm.
I would already be worried if she knows how to sell a stock from my portfolio. So if I think about a widow stock that they cannot touch for 20 years, I will buy Microsoft hand over fist straight away. It will be my core position now to put all my wealth. I would not put everything in one basket, but a lot will go to Microsoft as a widow stock. I think perfect widow stock.
I like thinking that long term. I think it's a great way to invest, and I would agree with you.
Nice. You just redeemed yourself from IBM, by the way, by picking Microsoft, one of your Dividend Growth investors' favorites. So,
I bought Microsoft at $40, guys.
Did you really?
Yeah. I when Satya came, I read his book Hit Refresh. About he wasn't what I loved about him. He wrote this book in the mid of the turnaround, not afterwards claiming success. He shared his thinking, his philosophy. You need to know Agile was popping up a little bit. For me, it was clear this guy is going to knock it out of the park. So I just had to buy it. I just wish I went like you to the bank and bought all I could.
Yeah, I wish I was more into tech when I was younger. I bought into the idea that I'm a value investor, so I have to pick cigars off the floor, and I think that unfortunately I missed out on a lot of what could have been like the Amazons of the world. Just buy and hang on to it. Even Google. Like I bought the IPO, I made some quick money, and I sold it, and because I thought I was a value hunter, I never bought it again. It doesn't. This idea of I'm a growth investor or I'm a value investor, I think is a label that was invented by mutual fund companies to sell a product.
But Cameron, look at it. Apple was trading at a multiple of, was it 10 or 11 a few years ago? Yeah, because iPhone was dead. Microsoft at the time had the same. Google, Facebook, you mentioned. So I believe these stocks, we are living now in a period where companies are just richly valued. Yeah, but we also, and I just believe this sector will come into normal valuation multiples at a certain moment in time again. It's just so hard to be patient, right, with these kinds of quality names.
I think so. I mean, at some point it will, but at that point, the company might be significantly larger than they are now, And I guess the question is, do you buy into it now knowing it's going to grow and eventually the multiple is going to come down? Are you better off with a company with a lower multiple in the future, but earnings are much higher?
But you show that really nice on your YouTube channel always, because the last part of the video is always like, this is what you would pay for it in 2035, I think it is,
Yes.
something like that. So 14 years out or 10 years out.
I go 10 years out, and I bring the multiple down because it's a mature company.
Yeah, exactly. And then actually, I think, which one was it I saw the other day, where it was like $160 versus $160 today. So,
Every
what's
now
the
and then
value of?
Exactly.
Yeah,
That
I like
happens
that
in
way
some
of
of the
thinking.
growth stocks. Like Tesla's a very real hard one to do. I mean, that multiple you're paying is way too high for the cash flows that are coming down in the future. And if you bring that multiple down to a normal size car company, even with their software piece, that pressure of the multiple adjustment is going to outweigh any earnings growth that they will achieve.
Yeah. And that's where investing becomes an art and not a science, right?
Yeah. It's like where do you want to put your bet? Like where do you want to lay the risk on?
Super.
So I think that's a nice way to end the show. Cameron, it's been a pleasure having you on. It's been great fun. It's been lovely chatting with you. We've learned a lot. I've taken a lot of notes here, so I'll have to go through this. But thank you so much for coming on. It's been enjoyable.
I've really enjoyed it. Thanks so much for the invite. It's great to meet you guys, and I'd love to trade ideas on the European stock market. Let me know if you want to see anything.
Yeah, and also ping us if you need inspiration. We'll definitely share some tickets with you to further look into.
Yeah, sounds fantastic.
Cool. And then to our listeners, again, thanks for listening. Thanks for all the questions. We really appreciate it. And we will see you all next week.